Janard Trust here. So the real trap of credit cards is not just the interest rate itself, but the combination of psychological and structural features that make it easy to fall into a cycle of long-term debt. So while high interest rates are certainly a danger, often over 20% or even 27%, the deeper trap lies in how credit cards encourage overspending, promote only minimal payments, and apply fees that multiply quickly when payments are missed, right? Now, there's the minimal payment trap, right? Credit cards allow you to carry over a balance each month if you pay only the minimum required. So this payment is often structured to cover just the interest, with only a tiny amount going toward the principal, making it possible to remain in debt for years, even with steady payments. So as a result, debt can linger and grow, basically allowing interest to compound and trapping cardholders in a cycle that's hard to break. There's the temptation to overspend. So because credit is revolving and immediately available, it's easy to spend more than you can afford, money you wouldn't necessarily spend if you were using cash. So this revolving feature makes it simple to accumulate more debt with just a swipe without confronting the full impact of your spending in real time. Fees pile up. So apart from interest, cardholders can be hit with a range of fees: late payment fees, over limit fees, cash advance fees, and annual fees, which quickly add to what you owe even if your interest rate isn't the highest, right? So debt becomes persistent. Credit card companies rely on the likelihood that consumers will make mistakes or experience financial stress, missing payments, or carrying balances, because that's when profit is maximized. So even a small balance can balloon over time due to these combined factors. Now, here are basically practical ways to avoid falling into the interest trap of credit cards, right? Center on the mindful usage, payment discipline, and proactive financial habits. So number one, let's start with pay your credit card bill in full every month. This is very simple, right? This is the single most effective way to avoid interest charges, right? Interest only accrues on balances carried month to month. So if you pay the full statement balance by the due date, you won't pay any interest. So avoid only making minimal payments. So paying just the minimal results in most of your payment going to interest, barely reducing your principal and causing debt to linger for years. You can set up automatic payments, right? Automatic payments help ensure you never miss a payment and always pay, at least the full statement, balance, avoiding late fees and interest. You can stick to a budget and monitor your spending. So regularly review your credit card transactions and set spending limits to avoid accidentally overspending, which could make it difficult to pay off the balance in full. You can establish an emergency fund. So relying on credit cards during emergencies, where there's job loss, unexpected bills, etc., often leads to debt cycles. So building a small emergency fund decreases the likelihood of turning the credit cards for unplanned expenses. Be cautious with credit card perks and introductory offers, right? So basically that's attracted by rewards or 0% APRs. People often spend more or overlook the high interest rates that kick in after the promotional periods, right? Always read the fine print and have a plan to pay off any promotional balances before regular interest applies. You have to limit the number of credit cards you use as well. Managing multiple card balances increases complexity and the risk of missing payments, which can lead to high interest and fees. You want to consolidate the debts if needed. So if you are already carrying a balance at high interest, a balance transfer card with a 0% intro APR offer or a debt consolidation loan can give you a window to pay down debt interest-free, but only if you stop adding new charges and pay off the balance before the promotional period ends, right? Pay multiple times per month. So making several payments throughout the month can help you keep your balance low and minimize interest on average daily balances, especially if you can't pay in full immediately, right? Avoid using credit cards for routine purchases when you don't have the funds to pay them off. Credit cards should not be a substitute for money you don't have. Consistently carrying a balance is the fast track to falling in the interest trap. Now, we talked about a whole bunch of things. However, I wanted to conclude with, just providing guidance when it comes to cards with the longest 0% intro APRs, right? So that you can do a little bit more research in them, because again, you don't want to pay interest at all, right? You just want the money. So there's the Wells Fargo Reflect card. It has 0% intro APR for up to 21 months on purchases and qualifying balance transfers. Afterward, the APR reverts to a variable rate, right? There is this, it has basically 17.24% to 28.99%. The balance transfers must be made within 120 days to qualify for the promo rate. We have the Citi Simplicity card, which is 0% intro APR for 21 months on balance transfers. It must be completed within 4 months of opening and 12 months on purchases, right? No late fees, no annual fee, no penalty APR. Now, here are some popular cards with 0% APR and rewards. You have the Capital One Venture One Rewards, right? 0% intro APR on new purchases for a limited period, right? That's the intro length not specified in the provided content, but typically around 15 months. There's no foreign transaction fees, so it's basically useful for travelers and those looking for straightforward rewards. There's the Chase Freedom Unlimited, has 0% intro APR for 15 months on purchases and balances transfers. It's the industry standard, right? You can, it basically offers cashback rewards and no annual fee. There's the American Express Blue Cash Everyday Card. It has 0% intro APR on purchases for a limited time. Strong rewards on everyday categories like groceries and no annual fee. There's the Capital One Quicksilver Cash Rewards Credit Card. 0% intro APR for 15 months on purchases and balance transfers. It has unlimited, 1.5% cash back on all purchases, no annual fee, right? There's the Bank America, credit card, has 0% intro APR for 18 billing cycles on purchases and any balance transfers made in the first 60 days, which reverts to a variable APR afterward. That's what I have for you today. Please take a moment right now, hit that subscribe button and like button. I appreciate if you're stay safe. See you in the next video.